Global shipping moves more than 80% of the world's traded goods, yet the system that keeps economies connected relies on a surprisingly fragile network of narrow sea routes known as chokepoints. These strategic passages, including canals, straits, and congested maritime corridors, handle enormous volumes of cargo every day. When traffic flows smoothly, the complexity remains invisible to most people. However, recent disruptions have exposed how vulnerable this system can be. Events such as canal blockages, regional conflicts, and climate-driven delays revealed that a single incident in one location can ripple across supply chains worldwide. Ships carry energy resources, food supplies, industrial components, and consumer goods, meaning any slowdown affects industries far beyond shipping itself. Companies depend on predictable delivery schedules to manage inventories, and even minor delays can trigger shortages or price increases. As global trade expanded over decades, vessels grew larger and routes became more concentrated, increasing efficiency but reducing flexibility. Ports and canals now operate near capacity, leaving little margin for unexpected disruptions. Meanwhile, geopolitical tensions and environmental challenges add new layers of uncertainty. Nations compete for control over strategic waterways, while rising temperatures alter ocean conditions and strain infrastructure designed for different climates. Despite these risks, much of the world's economic planning still assumes uninterrupted maritime flow. The idea of a shipping collapse may sound dramatic, yet the real concern lies in gradual stress building within the system rather than a sudden halt. Understanding the chokepoint crisis requires looking beyond isolated incidents toward the structural pressures shaping global logistics today. Shipping is not merely about moving containers, it forms the backbone of modern economic stability. When this backbone experiences strain, the effects extend into energy markets, manufacturing, and everyday consumer prices across continents. The greatest risk to global trade may not be a single disaster, but the growing pressure on routes that the world cannot easily replace. The modern shipping network depends heavily on a small number of geographic choke points that concentrate enormous volumes of global trade into narrow passages. Routes such as the Suez Canal, the Strait of Hormuz, the Strait of Malacca, and the Panama Canal handle cargo flows linking continents, making them essential arteries of the global economy. These locations reduce travel distance and fuel costs, allowing companies to move goods efficiently across long distances. However, efficiency comes at the cost of resilience. When ships crowd into limited waterways, even minor disruptions can cascade into global delays. A single grounded vessel or regional security incident can force rerouting that adds weeks to delivery times and significantly increases shipping expenses. Insurance costs rise, fuel consumption increases, and supply chains must adjust rapidly to unexpected changes. The concentration of traffic also creates strategic vulnerabilities. Governments and private companies closely monitor these routes because they influence energy security, food distribution, and industrial production. Political tensions in key regions can quickly translate into economic consequences worldwide. Climate factors further complicate the situation. Drought conditions affecting canal water levels or extreme weather disrupting ports illustrate how environmental shifts interact with geopolitical risk. Shipping companies attempt to mitigate exposure by diversifying routes or investing in advanced logistics technology. Yet physical geography limits how much flexibility exists. Unlike digital networks that can reroute data instantly, maritime trade depends on fixed natural corridors that cannot expand easily. As global demand grows, these choke points face increasing pressure from larger vessels and rising cargo volumes. Understanding the choke point crisis means recognizing that global trade has optimized for speed and efficiency rather than redundancy. This optimization makes the system powerful during stable periods, but fragile during uncertainty. The world built a trade system designed for efficiency, yet that same efficiency quietly concentrates risk into a few narrow passages that carry the weight of global commerce. One of the biggest structural pressures on global shipping comes from the rapid growth in vessel size over the past 2 decades. Shipping companies introduced ultra-large container ships to reduce costs per unit, allowing more goods to travel in a single journey. While this strategy improved efficiency during periods of stable trade, it also increased dependence on ports and canals capable of handling these massive vessels. Infrastructure upgrades have struggled to keep pace with the scale of modern fleets. Many ports face congestion because cranes, storage yards, and rail connections were not designed for such concentrated cargo volumes. When a single megaship arrives late or encounters technical issues, entire port schedules can collapse, creating delays that ripple through global logistics networks. Larger vessels also reduce flexibility. Smaller ships could reroute more easily during disruptions, but today's megacarriers require deeper channels and specialized terminals, limiting alternative pathways. Insurance and safety risks rise as ships grow larger, particularly in narrow waterways where maneuverability becomes more complex. Environmental factors add further challenges. Stronger storms, changing ocean currents, and shifting sediment levels affect navigation, increasing the likelihood of accidents in already crowded routes. Shipping alliances formed to maximize efficiency sometimes unintentionally concentrate cargo into fewer journeys, amplifying the impact of delays when problems occur. Companies now face a paradox. The same innovations that reduced costs also increased systemic fragility. Governments and port authorities are investing heavily in modernization projects, yet expansion takes years and requires international coordination. Understanding vessel scale reveals how global trade prioritized short-term efficiency gains without fully accounting for long-term resilience. As trade volumes continue rising, the gap between infrastructure capacity and shipping demand becomes a defining risk shaping the future of maritime logistics worldwide. Bigger ships promised efficiency, but their sheer scale may be turning global shipping into a system where one delay can disrupt entire continents. Geopolitical tensions are increasingly turning global shipping routes into strategic pressure points, adding another layer of risk to the choke point crisis. Many of the world's busiest maritime corridors lie near regions with ongoing political disputes or military competition. Control over these routes provides economic leverage because blocking or disrupting traffic can influence energy supplies, manufacturing chains, and global prices. Nations invest heavily in naval presence and port infrastructure to secure influence over strategic waterways, transforming shipping lanes into arenas of geopolitical signaling. Even without direct conflict, rising tensions can increase insurance premiums and force shipping companies to adjust routes preemptively, raising costs across the supply chain. Sanctions and trade restrictions further complicate maritime logistics, as ships must navigate complex regulatory environments that vary across jurisdictions. Companies face difficult decisions about which markets to serve and which routes remain safe or economically viable. Cybersecurity risks also grow alongside geopolitical rivalry, as digital systems managing navigation, port operations, and logistics networks become potential targets for disruption. The interconnected nature of modern shipping means that instability in one region can create delays far beyond the original conflict zone. Governments attempt to maintain open sea lanes through diplomatic agreements and international maritime law, yet enforcement depends on cooperation that can shift rapidly. The choke point crisis therefore reflects not only physical geography, but also the evolving political landscape shaping global trade. Shipping companies must balance efficiency with risk management in a world where maritime routes carry both economic and strategic significance. Understanding this geopolitical dimension reveals that the future of shipping will depend as much on diplomacy and security as on engineering and logistics. As competition between nations intensifies, the sea lanes that once connected the world may become the very routes where global tension is felt most sharply. Climate change introduces another powerful pressure on global shipping, transforming environmental shifts into logistical challenges that directly affect trade stability. Rising temperatures and unpredictable weather patterns alter ocean conditions, creating new risks for vessels navigating already crowded routes. Stronger storms increase the likelihood of delays, damage to cargo, and disruptions at major ports. Changing rainfall patterns affect canal operations, particularly in regions where freshwater systems regulate ship transit. For example, lower water levels can limit how many vessels pass through key canals each day, forcing companies to reroute cargo over longer distances. Melting Arctic ice opens potential new routes, yet these pathways remain unpredictable and require specialized ships capable of handling extreme conditions. Environmental regulations aimed at reducing emissions also reshape the industry. New fuel standards and carbon reduction targets encourage investment in cleaner technologies, but the transition increases costs and requires adjustments to global supply chains. Ports must upgrade infrastructure to support alternative fuels and energy-efficient operations, creating a complex balance between sustainability and efficiency. Insurance companies monitor climate risks closely, adjusting premiums based on exposure to extreme weather zones. Shipping companies increasingly rely on advanced forecasting tools to anticipate disruptions, yet uncertainty remains high. The environmental dimension of the choke point crisis highlights how physical geography interacts with global climate systems. As oceans change, routes that once seemed reliable may become more volatile, challenging decades of logistical planning. Shipping networks must adapt to a future where environmental factors influence not only safety but also economic strategy. Understanding these climate pressures reveals that the stability of global trade depends on how effectively the industry responds to evolving natural conditions. The ocean itself is becoming a variable in global logistics, turning climate change into a silent force reshaping how goods move across the world. Port congestion has emerged as another critical factor, intensifying the global shipping choke point crisis, revealing how vulnerabilities extend beyond narrow sea lanes into the infrastructure that connects ships to land. Modern ports operate as complex ecosystems where cargo moves through cranes, storage yards, trucks, and rail networks before reaching final destinations. As trade volumes increased and vessels grew larger, many ports struggled to expand capacity at the same pace. Even when shipping routes remain open, congestion at key terminals can create delays that ripple across global supply chains. Labor shortages, automation challenges, and outdated infrastructure further complicate operations. During periods of high demand, ships may wait days or weeks offshore, increasing fuel costs and disrupting delivery schedules. These delays force companies to rethink inventory strategies, shifting from just-in-time logistics toward more resilient but expensive systems. Urban development around major ports also limits expansion, as cities compete for land use while residents raise environmental concerns about pollution and traffic. Digital coordination tools promise improvements by optimizing scheduling and cargo tracking, yet integration across international partners remains uneven. Governments invest heavily in modernization projects, but construction timelines often stretch for years, leaving immediate bottlenecks unresolved. Port congestion demonstrates that the Chokepoint crisis is not limited to a few famous canals or straits. It reflects a broader imbalance between growing trade demand and physical infrastructure capacity. Shipping networks rely on synchronized timing, and when ports fall behind schedule, disruptions cascade throughout the entire system. Understanding this dynamic highlights how efficiency gains from larger ships and faster logistics can backfire when supporting infrastructure cannot keep pace. The true choke point in global shipping may not be a single canal, but the overloaded ports, where the entire system slows down. Energy transport represents one of the most sensitive aspects of the global shipping choke point crisis, particularly because oil and liquefied natural gas shipments depend on a few highly strategic routes. A large portion of the world's energy supply passes through narrow maritime corridors, making these locations critical to economic stability. Any disruption in these routes can quickly influence fuel prices, electricity costs, and industrial production worldwide. Tankers carrying crude oil and gas must navigate politically sensitive regions, where tensions or security incidents can create immediate uncertainty. Even the threat of instability can push shipping companies to reroute vessels, increasing travel time and raising insurance premiums. Energy markets respond rapidly to such changes because supply chains operate on tight margins. Governments closely monitor these choke points to ensure uninterrupted flow, sometimes deploying naval forces or negotiating diplomatic agreements to maintain open sea lanes. The growth of renewable energy reduces some reliance on fossil fuel shipping, yet traditional energy cargo remains essential for many economies. Infrastructure limitations also play a role, as specialized terminals are required to handle liquefied gas shipments safely. Environmental risks add further complexity, since accidents involving energy cargo can have severe ecological consequences, prompting stricter regulations and higher compliance costs. Shipping companies must balance efficiency with safety, often investing in advanced navigation technologies to reduce risk. The energy dimension of the choke point crisis reveals how maritime logistics intersects with geopolitics, environmental policy, and global economic stability simultaneously. Unlike consumer goods shipments, energy transport carries immediate consequences for households and industries alike. Understanding this connection shows why disruptions in shipping routes resonate far beyond the maritime sector, influencing everything from inflation to international diplomacy. When energy flows depend on a handful of sea lanes, even small disruptions can send shockwaves through the entire global economy. Technology and automation are often presented as solutions to the growing risks facing global shipping, yet they introduce new complexities that shape the choke point crisis in unexpected ways. Modern vessels rely heavily on digital navigation systems, satellite tracking, and automated logistics platforms that coordinate cargo movements across continents. These tools increase efficiency by allowing shipping companies to optimize routes, monitor weather conditions, and reduce fuel consumption. Ports increasingly adopt automation through robotic cranes, digital scheduling, and artificial intelligence systems designed to streamline operations. However, as maritime logistics becomes more dependent on interconnected digital infrastructure, cybersecurity risks grow significantly. A disruption to a major shipping platform or port operating system could halt operations without a single ship moving out of place. Cyber incidents targeting navigation systems or logistics software have raised concerns about the resilience of global trade networks. Automation also reshapes labor dynamics within the industry. While technology improves productivity, it reduces reliance on manual roles, creating tensions between efficiency goals and workforce stability. Smaller ports and developing regions may struggle to adopt advanced systems, widening the gap between major logistics hubs and less developed infrastructure. Shipping alliances and data sharing platforms require high levels of coordination between companies that traditionally competed, introducing new challenges related to trust and governance. The push toward digital transformation reflects the industry's effort to manage rising demand and environmental pressure, yet it also reveals that technological progress does not eliminate vulnerability. Instead, It shifts risk into new domains where physical disruptions combine with digital threats. Understanding the role of automation highlights how global shipping evolves not only through engineering innovation, but through complex interactions between technology, security, and economic strategy. As shipping becomes smarter and more connected, the greatest vulnerability may move from the ocean itself into the invisible digital systems guiding every voyage. Another pressure shaping the global shipping choke point crisis comes from shifting trade patterns and the gradual reorganization of supply chains. For decades, globalization optimized production by concentrating manufacturing in specific regions, particularly across Asia, while shipping routes evolved to serve predictable flows between major economic hubs. Today, geopolitical tensions, trade diversification strategies, and efforts to reduce dependency on single markets are reshaping these patterns. Companies increasingly explore near-shoring or friend-shoring, moving parts of production closer to consumer markets or politically aligned regions. While this diversification may reduce long-term risk, the transition period places additional stress on shipping networks as routes adjust and cargo flows become less predictable. Ports that once handled stable volumes must now adapt to fluctuating demand, while emerging routes face infrastructure gaps. Shipping companies must redesign schedules and alliances to respond to changing trade relationships, creating temporary inefficiencies that ripple through the system. The expansion of e-commerce further complicates logistics by increasing demand for faster delivery, pushing shipping companies to prioritize speed even when capacity remains limited. Smaller shipments, tighter delivery windows, and growing consumer expectations place pressure on maritime networks designed for bulk trade. Governments also influence trade flows through tariffs, sanctions, and regional agreements, sometimes redirecting cargo toward alternative pathways that were not originally designed for heavy traffic. These evolving patterns highlight how the choke point crisis is not only about geography, but also about economic transformation. As supply chains shift, global shipping must constantly adapt to new realities, balancing resilience against efficiency. Understanding this evolution reveals that the future of maritime trade will depend on how quickly infrastructure, policy, and logistics strategies adjust to a world where trade routes are no longer fixed but continuously evolving. The real disruption may not come from a single blocked canal, but from a global trade map that is quietly being redrawn in real time. Insurance markets provide another perspective on the growing risks surrounding global shipping, revealing how financial signals often detect instability before physical disruptions occur. Marine insurers evaluate factors such as geopolitical tension, climate exposure, piracy risk, and port congestion when determining coverage costs for vessels and cargo. As choke point vulnerabilities increase, insurance premiums for certain routes rise significantly, influencing how shipping companies plan their journeys. Higher premiums can make traditional routes less economically viable, encouraging rerouting that adds distance and delays. Financial institutions monitor these trends closely because insurance costs reflect perceived risk across the entire maritime ecosystem. When insurers classify a region as high risk, shipping companies may require additional security measures, increasing operational expenses that ultimately affect global trade prices. The insurance industry also plays a role in shaping safety standards, encouraging adoption of advanced navigation systems and environmental compliance measures to reduce liability. However, the growing complexity of risk assessment highlights how interconnected shipping has become with global finance. A cyber attack on a major port, for example, can trigger financial losses that ripple through insurance markets, affecting coverage availability for future voyages. Climate-related risks further complicate pricing models, as extreme weather patterns make historical data less reliable for predicting future events. Governments sometimes intervene to support shipping insurance during periods of conflict or crisis, recognizing that maritime trade underpins national economic stability. Understanding the insurance dimension reveals that the choke point crisis extends beyond physical infrastructure into the financial systems that enable trade. Rising costs act as early warning signals, indicating where pressure is building within global logistics networks. When insurers begin treating sea lanes as high-risk zones, it signals that global trade may already be entering a more fragile and uncertain era. Efforts to reduce dependence on traditional choke points are already reshaping long-term planning within the shipping industry, as governments and companies search for alternative routes and technologies that increase resilience. Some countries invest heavily in expanding port capacity or developing inland logistics corridors designed to bypass congested maritime passages. Rail connections linking Asia and Europe have gained attention as potential complements to ocean shipping, offering faster delivery for certain goods, even if costs remain higher. Arctic routes attract interest as melting ice creates new navigation possibilities, though environmental risks and unpredictable conditions limit immediate scalability. Infrastructure megaprojects, such as canal expansions and new transshipment hubs, attempt to relieve pressure on existing choke points. Yet these initiatives require massive capital investment and long construction timelines. Shipping companies also experiment with diversified fleets, balancing megaships with smaller vessels capable of accessing alternative ports. Digital planning tools allow logistics managers to simulate disruptions and adjust routes proactively, improving response times during crises. However, building redundancy into global trade systems often conflicts with efficiency goals, forcing businesses to weigh resilience against profitability. Governments collaborate through international maritime organizations to maintain open sea lanes and coordinate safety standards, recognizing that no single nation can secure global shipping alone. These efforts reflect a growing awareness that the chokepoint crisis is structural rather than temporary. The industry must evolve toward flexibility, even if doing so challenges decades of optimization built around cost reduction. Understanding these adaptation strategies reveals that the future of global shipping will depend not only on avoiding disruption, but on designing systems capable of absorbing it without collapse. The race to build alternative routes shows that the world is quietly preparing for a future where traditional sea lanes can no longer be taken for granted. Ultimately, the idea that global shipping is about to collapse reflects a deeper concern about systemic fragility rather than an imminent shutdown of maritime trade. The Chokepoint crisis reveals how decades of optimization created a network that functions efficiently during stability but struggles when multiple pressures converge at once. Larger ships, concentrated routes, geopolitical tensions, climate change, digital risks, and evolving trade patterns all interact within a system designed for speed rather than redundancy. Shipping remains essential to the global economy, and companies continue investing in innovation, infrastructure, and risk management to maintain stability. However, resilience requires acknowledging that disruptions are no longer rare anomalies but expected challenges shaping long-term planning. Governments increasingly recognize the strategic importance of maritime logistics, integrating shipping security into broader economic and defense strategies. Businesses adapt by diversifying suppliers, building larger inventories, and exploring alternative transport methods to reduce dependence on single routes. The future of global trade will likely involve a balance between efficiency and flexibility, where supply chains prioritize adaptability alongside cost control. While headlines often focus on dramatic scenarios, the real transformation occurs gradually as industries redesign networks to withstand uncertainty. The chokepoint crisis therefore serves as a warning rather than a prediction, highlighting vulnerabilities that demand coordinated responses across nations and sectors. Understanding this evolution reveals that global shipping is unlikely to disappear, but it will continue to change as technology, geopolitics, and environmental pressures reshape the oceans. The stability of the global economy depends on how effectively these changes are managed, making maritime strategy a central issue for policymakers and businesses alike. The future of shipping may not be defined by collapse itself, but by how the world adapts to a system that can no longer rely on perfect stability.